Okay, so good morning, everyone. Welcome to the new week. And this is the macro snapshot. We are Monday, March the 17th, 2025. Let's just start looking at a few charts and see what's going on. First of all, I just want to share like a sort of a general point that this week we have the Bank of Japan, we have the Bank of England, we have the Swiss National Bank, and of course we have the Fed. The Swiss National Bank is expected to cut 25 basis points, but the other three big central banks, the Fed, the BOE, and the BOJ are expected to do absolutely nothing and to actually, try not to rock the markets at all. And that's because they need data. At this point, we're in a sort of an equilibrium point, and especially, let's say, at the Fed, they need data. Global real yields are quite elevated at the moment. We see the real yields in the US are elevated. We see that the yields over in Germany with the German bunds have gone up a lot. The real yields much more above inflation. And that the only way that real yields are coming down is unless we get a dramatic slowdown or some kind of recession. So, for example, the core PCE or the PCE in the US is about 0.3 per month, which annualizes out to about 3.6, 3.7 per year. So the point is that inflation is still sticky. So nominal and real yields can only come down and be reduced until and unless we get some kind of economic slowdown. But at this point, we just don't have that. The data is not really helping us. And so that means that the Fed this week, in terms of their dual mandate, the employment situation seems quite solid. And in terms of reducing interest rates, they cannot do that because inflation is still sticky. So the only way they will reduce interest rates, cut interest rates, is if there's a real slowdown. And we just don't have that. So I expect Powell this Wednesday to be as boring as possible. What was interesting over the weekend, again, for the third, fourth, fifth time, we had Treasury Secretary Bessent essentially giving this idea of the detox that the U.S. economy was addicted to government deficit spending, and that the U.S. economy and the stock market even needed to detox, and a healthy correction or a correction was healthy and not a problem, and they're much more focused on the medium term. So it's going to be interesting today to see whether the market takes him at his word, basically. It's interesting. If you look last week, you can see that the stocks were down overall. So this is last Monday. So you can see that the stocks are down overall. This is the SPX index here. But if you look at, let's say, something like the 10-year, it actually didn't rally at all. So we had a situation where the stocks were coming down quite aggressively in the US, but the bond market didn't rally. And that's really telling you that the bond market is still concerned about deficit spending, even though Doge is possibly doing something, but it doesn't look as though the Department of Government Efficiency under Musk actually will achieve, the great cost savings which have been touted. And sort of trumpeted about the place. Secondly, the bond market seems to be concerned that inflation is still sticky and going away, and also the bond market is signaling to us that it doesn't think that the U.S. economy is severely weakening. So that's the situation we're at the moment. We're in a kind of equilibrium, and if we look at, let's say, something like the 2-year yield, just give us a sense of that. We can see here that we are expecting a cut in June, and maybe at this point we have 2.5 cuts. So if we actually just look at this at the market pricing here, we can see that what the market is pricing for December is 2.5 cuts. Now, if you remember, about a week, 10 days ago, that was at 3 cuts. So the market's come in a little bit more and basically saying, hey, 2 to 2.5 cuts, with the first full cut priced in by about sort of June or July, depending which way you look at it. So about June or July is for the first cut. But at this point, any time before then, so obviously this Wednesday, and also then for the May meeting, you'd have to say that the Fed will not do anything at all until and unless it gets some signal that the labor market is slowing down and the real economy in general is also slowing down. So if we look at the 2-year yields here, we can see that this low here at about 3.86%, it's probably the low for the moment because, as I say, unless we get some crazy fall down in inflation or we get a real weakening in the real economy and the employment situation, this will probably represent the low at the moment. Similar kind of thing here if we look at the 5-year yields, you can see a kind of double bottom retest about 3.90. Again, that's probably the low for the foreseeable future. What we do have today coming up this morning in about an hour or so, we do have retail sales. Is that going to start showing us some sort of signal that the real economy is slowing down and that the US consumer is weakening? Possibly. Although there is some sort of talk, reading a lot of commentary and a lot of analysis over the weekend that basically, a fear of sort of the tariffs has led a lot of people and a lot of companies to front run. So there's been a lot of sort of purchasing to try and avoid any potential tariffs. Now, keep in mind the tariffs. Trump keeps on talking about this magical number on April the 2nd, not April the 1st, April Fool's Day, but on April the 2nd, apparently, all kinds of tariffs, reciprocal and universal, are coming in. No one has any details. And of course, Trump has shown that we can't really sort of trust his words, so to speak. But it does seem that in some shape or form, we are getting tariffs on April the 2nd. And I think that's also why the American stock market is reluctant to have a fully blown rally. It's going to be difficult to rally. And it's also going to be difficult for yields to come down too much until and unless we get more clarity on the tariff situation. So over in Europe, of course, kind of an interesting situation. We what we saw last Friday and also over the weekend was that it does seem as though the Green Party and the other parties have agreed on a compromise for the deficit spending, for the infrastructure spending, for the defense spending. What we've seen is that the uh, having said that, though, we have seen that there's been a little bit of a rally in the bunds this morning, and you can see that the yields are coming down just a little bit. Overall, the curve should steepen on this. But the point here is that if you look at the 2 year, the yields have come down a little bit. But if you look at something like, let's say, for example, the 30, you see a huge difference. So look at, again, I'll put it back. You see the 2 year yields on the shots, that's gone up quite a bit, but it's come down a little bit. And then you look at something like the 10-year bond, you can see it's gone up a lot more and has come in a little bit. The reason the yields are coming down a little bit this morning, and therefore there's been a rally in the prices, is that there was some talk that at the last minute before the vote tomorrow in the lower house, the Bundestag, that there could be a few dissenters. But it seems that at the end of the day, this deficit and infrastructure, the deficit spending, the infrastructure and defense spending will go through. And that should basically sort of steepen the curve. If we look at some of the curves here, we can see that the German curve has steepened a lot. It'll probably keep on steepening. I would say maybe up to, even like 90 basis points or so. If you go back, there are some levels and you start looking around. So this can definitely steepen up a little bit more. I think we probably want to go up to about 88. 90 basis points, but it doesn't mean it can't come back down in the meantime. But that might be the top. So I think, we've got a few more basis points to steepen in the German curve. And because keep in mind that the funding for this defense and infrastructure will be using the 10 and the 30 year. So the long end of the curve, those yields should go up a lot more than the belly of the curve. But the thing is, like, if we think that this sort of yield curve is going to top out here, this yield, the twos, tens, this kind of spread will top out at, let's say, 88 or 90 basis points. I mean, maybe the Bund itself, so this is the Bund yield, just the outright Bund here, could that maybe, something like about 2.9 or 3%, just a little bit higher here. We're getting up there. Could that also be the top as well? So we're getting to a point here where the Bund yields have moved up a lot. If you go back until early December, we're at just over 2%. We're now just under 3%. So they've moved about 90 basis points or so. And you've got to think that around about 2.96 or even just squeezing up to 3 could be the top as well. And if we actually just put that, let's say, on a much longer term chart, let's say a monthly, you can see here, I'll just put this back. You can see here that that would be a pretty strong level to break around about that 3%. That's a pretty sort of strong levels. We're also seeing, if we look on the Bollinger Bands, which I'm going to put up here, that they are getting a little bit overextended. So I'm going to put it on the Bollinger Bands. And you can see here that we're also at the top of the monthly Bollinger Band. So normally, as you can see, the market doesn't like to spend too much time outside of the monthly Bollinger Bands, just going back through time. So the fact here, we are quite overextended a little bit. But that's not to say that, we can't, over the next longer term period, let's say 6 to 12 months, we can't push up, let's say, to this level, which would be about 3.5, 3.6%. But just for the moment, it does seem as though, the Bunds just having a little bit of a pause. But having said that, if we just go back then to the dailies, if if the bonds do come back a little bit, let's say about 2.7, this level down here is kind of an interesting level there. That would be probably too much. And so that would probably represent a sell. So if the yields come down here and the price goes up, at that point probably would be a sell, maybe buying some long put spreads or so on the Bund, because over time there's going to be more issuance, there is more deficit spending, there is more spending on defense. So I think what we're trying to do here is that any sort of retracement in terms of yields would be a buy, and of course that translates into selling any rallies, which is what we've had a little bit today. But it's not enough of a rally today. Something which is interesting is just looking at, let's say, the 230 spread over here in Germany. And you can see that that's come a long, long way, and it's getting quite sort of overextended at this point. I mean, maybe something like up here where we had a level around about 113 basis points. If we go all the way back here, you can see that that level around about, 111, 112, 113 represents probably, a good sort of resistance at this point. So, it still could, if it gets up there, we could have a little bit of a bounce as in terms of the bonds if we get up there. So all that to say that in Germany, it's looking a little bit overextended. There's probably a little bit more to go, but at that point, there could be some bounces here. If we look at the differentials, that's also giving us some interesting information. So this is now the US differential. So this is the US 2-year versus the German 2-year. And you can see here that we haven't done a huge amount, like it's gone out a little bit in favor of the US over the last 3 days, but it hasn't really moved. If you look compared to, like a week ago, it hasn't really moved too much. Whereas if you look at, let's say, the 10-year, so this is the 2-year, if you look at something like the 10-year, you can see it's come a lot more, and even in the 30. So you look at this, what's happened in the last week or so, you see that the 30-year, that has come in a lot. The 10-year has come down a lot. You see this big movement here. Whereas if we go something at the front of the curve, yes, it's come in a little bit, but not nearly as much. And in fact, if anything, is going out a little bit here. And that's, again, just because the funding for all of this German spending will be mainly funded by the long end. And that's why that differential is going out a lot more. But having said that, let's say, for example, the 2-year here, when and if it goes up to, let's say, 1 point up here somewhere, maybe 1.93, 1.95, something like that. That could also be a signal there that the Bund rally in terms of prices is over. So again, if this chart goes up, that means that US yields are going up higher and faster than the German yields. But let's say we get up to about 1.93, that's going to be in my sort of radar there. That could signal that, there's been enough of a correction, and that the Bund rally is, it's time to maybe start shorting the Bund in terms of prices again. Similar thing if we look at the 10s. If that gets up to, maybe this level here, fills the gap 160, even could fill the gap up to 165. But somewhere in the zone here, again, that could be a pretty good level to be shorting the Bund. And again, I think medium term, if the US economy potentially starts to slow down, the Fed starts cutting, all of those kind of things, but the German economy remains relatively robust, and there's still a lot of infrastructure and defense spending. If we do get this differential in the 10s, US German up to, let's say, 160, 165, I do believe at some point it's going to come back down again, maybe even down, to sort of 105 level down here somewhere. There's definitely some more downside if you look a bit further away. Okay. Excuse me. So much for bonds. Let's have a look at over the FX space. And we could maybe just start off with something like the euro. Now, the euro, again, daily chart here on the euro. So you can see here that the euro is sort of pushing up a little bit more. Quite an interesting week in the euro here. We have apparently tomorrow is going to be a call between Trump and Putin. If there is some kind of resolution, some further progress there in terms of a peace deal in Ukraine, which would be great for humanity, of course, that should be positive for the euro. We also have tomorrow, as I just mentioned, that the Bundestag, which is the lower house of parliament in Germany, as it is expected to pass, even if there is some dissension, it is expected to pass the spending and defense bill. So that could be a positive in terms of, sort of stimulus package for the German economy. And then the other thing which is interesting is that we have Lagarde on Thursday with a speech. And if we just actually look at what's priced in here for the the Eurozone, the ECB, which is here, we can see that we know they cut at their last meeting, but we see their next meeting in April. The market's pricing in here about a 50% chance of a cut. So you see here, about 13 basis points priced in. And that's going to be interesting to see whether Lagarde, she's speaking this Thursday, she wants to maybe pour some cold water on that idea that the ECB will be cutting again. And maybe she might want to introduce to the market some idea of a pause, and maybe at least pausing for the April meeting. And all of that should be pretty positive for the euro USD. But then the question remains, of course, how much can this actually rally? Because then, as we go through time, as I said earlier, we are getting to this sort of magical April the 2nd date, which Trump has sort of touted as being the date where, tariffs will come. There'll be a lot of tariffs imposed, including potentially tariffs on European products. So I think, in the short term, we could see the euro retesting these highs at 109.30, 109.40. Could it break through? Yes. But I have to say, I think it might be a little difficult for it to struggle above that 110, 111 level, just because structurally, it looks as though tariffs are coming and a lot of good news, so to speak, has been priced in. At this point, the market is basically saying there's not too worried about tariffs. We've had the German infrastructure and spending bill. We've had the peace dividend. So a lot of this move down from 102 up to about 110, a lot of this, I would suggest, has been priced in a little bit. In terms of other stuff, overnight we had a little bit of good news out of China, so to speak. There was sort of more talk of stimulus and stimulating the consumption and whatnot. So we see the Aussie up a little bit, probably the New Zealand as well. I haven't checked, but yeah, we see the New Zealand dollar also breaking out, just on this idea that China is stimulating. If we look at that, we could also probably observe that copper is having a little bit of a green candle here. Interesting level for copper. We see that this level at about 489, 490 is pretty key. You would have to say that if copper cannot rally on China's stimulus news, it's probably due to pull back here. This is quite a key level here. Personally, I'm agnostic on this one because it wouldn't surprise me if it pops up and retests up to 5. If it breaks out here, that could definitely want to retest up to this level at 5.119. Let's keep an eye on that. Gold is an interesting one because gold, as we know, just hit $3,000. This is the spot market here. So it looks as though it wants to sort of go to the top of the Bollinger Bands here. Actually, it's topping out above the Bollinger. I mean, the top of this sort of up channel here, which would be about, let's say, 3,050 on the cash. It is overextended. It's on the top of the Bollinger Bands. The RSIs are, relatively overbought and whatnot. But the point is, if people want to keep on buying gold, they will keep on buying gold. But it is technically overextended. And what is sort of interesting is to look at gold versus something. Let's say, for example, we put GLD and divide it by the commodities. So let's say GSG, something like that. We can see here that gold really has been outperforming the sort of the commodities, and so it's very, very expensive. It's also being outperforming something like tips. So if we look at something like GLD and divide it by tips. Now we know that the real yields are up, so which normally would be sort of obviously good for tip. But if we look at sort of GLD over tip, it's been outperforming the tips by a significant amount. And that's unusual because that gold, as we know, does not yield anything. It does not give any return. Whereas the tip, is inflation adjusted. And we know that real yields are about 2.5%. So very unusual outperformance of gold over tip. In this environment, one would have not expected that. What can I say? Is it a safe haven? Is it sort of central bank buying by the Chinese, et cetera, retail buying by Indians, Chinese, Brazilians, Turks, all that kind of thing? It's all possible, and there's a lot of evidence for that. But gold does seem to be just increasingly overextended. Can you short it? Probably not, but is it difficult to buy up here? Yes. What is interesting, if we just look at the commodities, and again, just go back to just a general sort of, go back to just a general ETF, something like GSG, which is the commodities. What's interesting is that if you go back, let's say for a year or two, just really sort of, zoom out here, we can see that if you go back all this way, going back to, 2000, I don't know, 22, something like that, commodities have really just been in this sort of ranging pattern. Now, obviously, and we're just at this point sort of in the midpoint of this range. And it's not particularly that strong, but let's say, for example, it gets down to 21, 25 or something down here, the bottom of the Bollinger Bands. That could be an interesting sort of buy. So just keep your eye on that one. As I say, just if it gets down towards the bottom of the Bollinger Bands, 2140, 21, 20, 30, something like that down here a little bit could be interesting because um, it's been ranging for this time, and yeah, at a certain point, you have to say with this sticky inflation and a global economy which seems reasonable, especially if the Chinese are starting to stimulate a little bit, and inflation at 3% globally, one would imagine that commodities would do a bit better. So that's just something which I'm sort of just interested in looking at. Hasn't done particularly well, but it does seem as though we're getting to a lower point here, as I say, just maybe down the bottom of this Bollinger Bands on the dailies, where it could be a buy. Now, just in terms of equities to finish off, the general sort of feeling seems to be here, sell US and buy the rest of the world, which of course is the opposite in the bond market. So in the bond market, we've got sell, European bonds and buy US bonds. So there does seem to be a little bit of rotation going on here. But if we look at, let's say, the uh, the 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 spot market here, we can see that something like a 56.70, 56, where are we? 56.70-ish, 56, something like around about here, 56.68, something around about here is a very sort of key level up here. That's the big swing level. We're having a little bit of a bounce this morning, but not much. 57.69 is the gap close. So we'll see here, what was it? 57.69, 57. Let me just find that. Around about here would also represent that's another key level. So the point here is that that could be around about the top, that sort of 57.70 sort of level around about here. So I think if we get above this 56.68 level, that could be interesting for a tactical day trade short, or more to the point, probably 57.70. If we get there, is probably going to be the top. But as I say, it doesn't look as though the White House is particularly going to be supporting equities, and I don't think Powell this Wednesday is going to be supporting equities particularly. I think he's going to be very, very neutral, and especially if he has the White House not on his back. I don't think they would mind if equities get down a little bit more. So we'll see what happens there. In terms of volatility, what is interesting is that we've seen that the volatility has fallen a little bit. You see here the last 4 or 5 days, we're now about 22 as we speak this morning. And what that's sort of indicating is that even though the stock market has been falling, does it indicate that maybe traders, rather than buying long puts, are maybe like selling calls? And that kind of makes sense that if you look at the SPX again, is that the market is rallying but without any particular strength, and so the market has come down a long way, but there seems to be a general reluctance to sort of be buying long gamma, so long calls. It's maybe more like selling calls is what's going on, and our traders sort of saying, hey, we think yes, it could rally up to maybe 56.68, or then maybe even 57.70, but at that point we'll be selling the call. So it's not even that sort of big institutions are selling their holdings, but simply they're basically saying, hey, for the rally, we'll sell the calls just to sort of hedge our position a little bit. So that's kind of a kind of an interesting one. I mean, again, if we look at global equity, sort of interesting. If you look at over in Europe, we can see again that's been rallying a little bit. It's still a little heavy. I mean, the reality is that last 3 or 4 days it's come off. Friday we had a bit of a pop, and this morning we've had a little bit of a pop. It's an open question as to whether that's going to achieve new highs. Again, like the euro, a lot of the good news has been priced into European stocks. We shall see. One thing I would say, though, as well, is that the Nikkei also doing okay, not tremendously well. But this general sort of theme of sort of reflation in Europe, Japan, and to some extent in China as well, that seems to still be in place. Whereas in the US, it seems to be sort of a bit of a concern, slowdown, nervousness, a selling calls rather than buying calls kind of situation. On the other hand, not really buying puts. So I think a lot of people are saying that, the big sell-off is maybe over for the time being. We could get some kind of bear market bounce. but maybe not a particularly strong one. Just one thing to keep in mind, guys, is always looking at a good barometer. And again, the reason I'm going to mention JP Morgan here is just because this is at a pretty key level. And I think that JP Morgan is a good barometer over the years for just how the US economy is doing and also how it's perceived. And you can see here that this is a very key level. It bounced off about 225 and a half here. Let's call it 225. So let's keep an eye on that just to see if that's bouncing up, because as long as that doesn't go down anymore, I think that's sort of the market telling us that the US economy is doing okay. And then another thing which is interesting is to look at Berkshire Hathaway, which, as you can see, is almost at a double top here. So that's certainly not collapsing. And despite the fact that the Warren Buffett sort of guru thing, the reality is that if JP Morgan is relatively, can hold this a little bounce here, and Berkshire here stays, quite bid. Berkshire is a very diversified business. One would have to think, or one would probably think, that if the US economy is really suffering, the real economy, that in some shape and form, Berkshire Hathaway will also suffer, and this stock price would go down. So the point I'm trying to make here is that as long as JP Morgan remains bid at that sort of bounce there, and Berkshire remains strong, I think the overall sentiment is that the US economy is doing okay. If that is the case, I think the White House won't overreact and will continue to put on their tariffs and do what they're doing, and be comfortable with deficit savings and cutting deficit spending and tax cuts. And on the other hand, I also think that indicates that the Fed will be in no particular hurry to slash or cut interest rates as long as the real economy is doing okay. All right, so that's sort of the thing. I think the watchword this week is patience. Central banks, as I say, I think will try and do not much at all. Let's look at retail sales. Again, that's a pretty choppy number. Let's see how how the market reacts to that. And I think at this point, it's really just a question of being super patient and waiting for great levels to either buy the euro on a dip or sell it if it gets up to that very elevated 110, 111 level. The German Bunds probably at a certain point. If they extend too much this rally, they're probably a sell again, but you have to wait for a good point to be doing that. Okay, guys, so I'll leave it there. I think I've spoken too long. Let's continue the conversation as we go through the week, and have a great week and a great day. Thank you.